Good afternoon, everyone. Welcome to another edition of our Wednesday market review. My name is Stock Darts, and we're going to do the usual. We're going to go ahead and cover the four major markets today. We're going to look at the S&P 500, the NASDAQ Composite, the Dow Jones, and the Russell 2000. Once we finish looking at those, we're going to take a quick look at the U.S. dollar, see how it's behaving, see how it's affecting gold and silver, and then take a look at oil as well and see if that has any that has been impacted at all by the U.S. dollar or anything else. Once we finish with that, we'll move on to the chart requests. If anyone in here has a chart request, feel free to type it in, and I'll take a look at it as soon as we finish going through the markets and commodities. If you like what you see here, you can follow me at StockDarts on Twitter. You can also find me on YouTube at StockDarts, and you can visit me at patreon.com/StockDarts, where I post weekly blog content. I usually put a trade idea on Monday. I'll repost these market reviews on Wednesday, and if I find anything relevant throughout the week, I'll post something on there as well. Other than that, let's go ahead and get started. First things we're going to do is take a look at the S&P 500. So here's a look at the ETF SPY, and as we can see, the market had a bit of a downturn towards the end of last week and beginning of this week, and while we did have a little bit of a bounce, we find ourselves still below a pretty critical area on the charts. For those of you that are regulars here and have been here before, you'll know that a couple of weeks ago I pointed out this 294 to 293 area as pretty critical on the S&P 500, and once we fell below there, it wouldn't necessarily mean that we were topping or turning bearish, but it would certainly mean that we would be stuck in a more neutral environment than what we were hoping for, what we were aspiring to before that, right? When we were up here on 295, 296, 297, the aspiration for the market was that we were just a hop, skip, and a jump away from all-time highs, and the possibility of taking a rally towards the end of the year and forging onto new highs was really the idea. Now, the fact that we've lost 294, 293 again, it's not to mean, like I said before, I want to reiterate, it doesn't mean that we've topped out, doesn't mean that we've flipped into a bearish market, but it certainly does mean that we've definitely remained in a neutral environment and a neutral market, and aren't quite as bullish as what it might have seemed earlier this month, or actually in early mid to September. So that's where we stand right now. We did find some support. You can see today's candle at the moment is a hammer. We could end up closing poorly. Again, I mentioned last week that there was the possibility when we found support, we'd come right back up to this area that was our previous support and would possibly turn into resistance, and that's what has turned out to be the case so far. However, I like the support that we found in the middle of yesterday. Even if we ended up closing at lows, we did find some buying once some news came out about the Fed looking at maybe extending or reintroducing a different form of QE. Then we have, of course, today continued news on back and forth with the U.S. and China and the trade wars that aren't really doing much of anything. And so the market is finding support. And I think the good thing to see from this is that despite the fact that we broke down through a pretty important area, we haven't really gone backwards on the year. And what I mean by that is we haven't lost the ground that we made up in August, and we definitely haven't come back and tested the ground that we pulled back to in June or anything before that. So the market continues to at least forge higher as far as the pivot lows. And what I mean by pivot lows is every time the market pulls back, it sets up a pivot, right? And we haven't really lost ground. We haven't backtracked and gone behind some of those pivots. So for the most part, we continue to find buyers higher and higher as the market goes forward, or as the year goes forward. And despite the fact that we have found some significant overhead resistance, we haven't turned around and come back to explore the bottom of our range. So despite the fact that I think we're still in a pretty neutral environment, the fact remains that we at least have a pretty good bullish undertone as far as this year is concerned. Now, what I mean by neutral environment is if you look at the weekly chart and you just pay attention to what we've done over the last 2 or 3 years, we've mostly traded sideways. Now, in this basically 2 years now, there's been some strong trends both up and down, right? We started off strong. We had a pretty strong backlash off of that, and then we had a nice rally through most of 2018 before the crash, or not the crash, but before the big drop at the end of the year. And then this year we've been basically just climbing steadily higher, but for the most part we've just been re-exploring the range that we've been kind of trading in. And then what I thought was pretty bullish was the fact that we were finally starting to confirm price action above that price range, and that's what I think that we've kind of backtracked into neutral or downshifted, is because we found ourselves back into this range, this rectangle that I'm drawing. And we're right back in it. We're still at the upper edges of it, and we're still building a momentum for a possible rally. So I think that things are still looking pretty positive. It's not nearly as negative as what you'd think if you just listen to the news or if you put too much emphasis in the most recent candles in the market. And if we can get right back up above 293, I think that bodes well for the market, despite the fact that a lot of people are looking at this and asking, is this a double top? Are we possibly about to turn right back down? And I think the potential for us to rally is still probably slightly stronger than the potential for this to be a double top. Now, we do have earnings season coming up in the next few weeks. You look over here, we have a couple of names reporting today, but nothing major. But if you look throughout the week, we've got the airlines that are going to start reporting this week, and then next week we're going to finally start getting some. We should be getting some financials and some other, yes. So here we go, JP Morgan, Citigroup. And then once we start really kicking through here, we'll start to get the tech names in the next couple of weeks, somewhere around the third to fourth week of October. We'll start to get a lot more names reporting, and we'll be really in the thick of things as far as earnings season is concerned. So that's an important consideration. The tone of earnings this quarter is probably going to have an impact on the market, particularly a market that right now is just going back and forth, trying to figure out what it wants to do and trying to figure out where it stands. I think that's really been the one synopsis or the one description I can have of the market from June to now, is that the market is not really sure whether it wants to go up or down. Now, that's obvious because, of course, we've just been chopping back and forth, but usually there's a nice undertone to the market, and it either is trying to climb higher or trying to pull back. And at the moment, it really is just kind of reacting to the whims of the news, because it doesn't really have a prevailing direction. And that's why, again, I think that we're in a neutral environment, particularly in the long term and in the short term. If you notice, in the short term, we've just been going back and forth sideways pretty much since we started exploring this 293 area. And with earnings coming up, hopefully we'll get enough of a consensus one way or the other to push the market either up or down. Now, of course, nobody wants the market to go down, but as long as the market is moving in one direction, it's a lot easier for us to trade, and it's something we could figure out. Oh, by the way, hi, Will. Thanks for joining. Those of you that are in here, by the way, I'm not sure if you have this stream chat popped up or not, but you can interact with me by just typing in the chat, and if you have a chart request, feel free to put it in there, and we'll go ahead and take a look at it. Let me just type it out real quick. If you have any chart requests. If you have any chart requests, feel free to add it in the chat, and I will go ahead and take a look at whatever chart you guys are looking at once we cover the stock market and once we look at a couple of commodities and the US dollar. So what I was saying before was we are still kind of figuring out where we want to go, and earnings might be the catalyst that tells us what kind of state we're in. And even if it's a negative earnings season and it ends up pulling the market down, what we need right now is to have all four of the markets starting to move together. That way they can maybe turn around together and start trying to rally as we close out the year. We still have a few weeks to go in October. October cyclically is a tougher month for the market, and as long as we kind of clean up our act by November and December, I think that there's still a pretty good chance that we forge on to new highs. Now, of course, a lot is going to depend on how we go ahead and navigate the next couple of weeks, and whether this does indeed turn into a double top, or whether this just becomes the next in a nice line of corrections and pullbacks in the market that leads to pushes higher as far as 2019 is concerned. And that's what we're going to look at. We're going to look at the major levels on the S&P 500. And as usual, if you're worried about a market top, or if you're trying to figure out if you should get aggressive, what we want to do here is we'll look at the S&P 500, we'll look at key levels, and as they get breached or as they get broken to the upside, that'll give us hints as to what the market wants to do. So like we discussed in the last couple of weeks, this 293 area was very critical in trying to decide whether the market was ready to push to new highs or whether the market needed more time to consolidate. At the moment, it's obvious we need more time to consolidate as we're back below that area, and we're basically trading sideways in that same range that we spent most of August and September. And now, if you're worried about a bearish downturn, well, I think the line in the sand for you is over here around 282 to 280. You can see that that was basically the last time we had a pullback, the last time that we got rejected off of highs. We came all the way down to 282, which was a critical area. You can see I've had it outlined for most of the year as a pretty important line in the sand, and I think that this is the spot that we look at if we're worried about a flip to the bear side. Once we lose 280, which was basically the breakout of this last retracement, and then turned into the nice support level for August or September, if we lose that level, there is a very strong chance that not only do we revisit the pivot low from June, but that we start to go ahead and probe lower and start to challenge the lows from the last year and a half to 2 years. So this is a very critical area, and that's really the line in the sand where we'd have to worry about whether things are turning bearish. Now, that would also mean that this would indeed be a confirmed double top, because we have a move up to 303, and then a pull back down to about 281, 280, a move back up to that area, and then a pull back down. And if we end up breaking below that area, then that indeed does look like a confirmed double top, and that would likely lead to a move downwards of, like I said, at least down to 272, and more likely than not all the way down to the 260s. So that would be your line in the sand, and I think the point where we'd have to reevaluate and start to decide whether the market is still neutral or whether it wants to turn into more of a bearish market. Now, that being said, in the longer term, there's a long way to go before we're really in a bearish market, right? Because if you take a look at what we've done over the last 4 or 5 years, we're still basically right next to all-time highs and well below even just the price action from 2-3 years ago. So the market would have to roll over very hard for us to start to lose some of these technical levels that are critical on the long-term chart. So I think long-term we're okay, but that doesn't mean that a drop down to 260, 250 is not going to impact a lot of traders, or not going to impact a lot of investors, or even people with retirement accounts. So what we want to do is make sure that if we see price action start to violate this 282 to 281 area, then we need that's when we know we need to put extra measures in to control our risk, and to perhaps you want to put some hedge trades in. Maybe you want to close out some positions, move more to cash or into safer stocks in order to protect yourself in case there is a continued downturn in the market. So I think that's kind of the key area to watch. The way we've reacted so far the last couple of days shows me that there's still a lot of buyers in the market. So I'm pretty confident that we're going to attempt to break 293 again. Not sure if we're ready for it. As I move through and look at different stocks, for those of you that maybe are unaware, I typically scan and go through at least 1,000 names a week, maybe 2,000 names, as I go through all the different equities. Right, I go through the S&P 500, all the Nasdaq components, a lot of the Russell 2000 components, and so I go through a lot of different names, and you get an idea of what the market's doing just by going through just all these different names. And until we see a further breakdown, we have to assume that the market wants to try to maintain this. I've seen a lot of names that are not ready, but I've seen a lot of names that are breaking down. And so what happens is we have a bit of a disconnect. And I think we're going to see that a little bit more clearly once we move to the Russell 2000 and IWM as we cover these 4 charts. When the market's really ready to rally, all 4 of the major market indices are moving together. And as you go through and look at hundreds of charts, they all are mimicking what the market is doing, and they're all kind of moving together. It's like a strong current, and the fish are kind of swimming with it. When you have a very weak current, or you have currents that are crossing, then all of a sudden you've got this mess, because you've got some stocks that are outperforming the market, you've got some that are trading the same, and you've got a bunch of them that are underperforming, and that's kind of where we stand right now. And as I go through a bunch of different names, I realize that, and it's not necessarily a terrible environment to trade in, because it becomes what I call a stock picker's market, where it's really important to figure out what stock you're looking at and make sure that you are disciplined and not just trying to chase the whims and fancies of the market. A lot of traders get into trouble in these scenarios, because when the market rallies up to highs, they get excited and they try to go long, and then they get trapped. And then the market pulls down and starts to trade back at lows, they get nervous and they start to short. And then the market comes back and starts bouncing again because the market is kind of directionless and trying to figure out what it wants to do. And it just keeps chopping traders back and forth that react to the most recent candles and try to chase the price action. What we need to do right now is just be disciplined and understand that the market is not really in a spot right now where it knows what it wants to do next. And like I said, maybe we get a little bit more clarity as we move through earnings season. Now, the clear area for us to worry about is 281 to 280. To the upside, what we want to see is a break above 293 to 294. If we can break that, there's a good chance that we eventually try to make our way right back up to all-time highs. And the idea is that if we can finish the next week or two above 294, there's a good chance that as we head into November and into the holidays, the market will make a move back up above 300 and start to challenge all-time highs. If we continue to flounder about these the low 280s, then there's a good chance that the market needs to probe lower and see exactly where the buyers are in and whether we do need to turn around and explore the bottom of that range. Now, again, I think the bottom of this range is far away, but that doesn't mean, and I don't think it's really in the cards at the moment, but as traders, we need to make sure that we understand what our risk is, and then we continue to be disciplined. Just because I feel like the market has a better chance of going up doesn't mean that I won't stop out or I won't flip bearish if the market continues to pull back. Matter of fact, the only trade idea that I looked at so far this week on my Patreon page was a bearish trade, and while it didn't work initially, it is starting to turn around now. So I'm open to the idea that we need to continue to pull back, but I'm also open to the idea that we need to move forward. And I think hopefully with earnings, we'll have a little bit of a clearer catalyst as to where we want to move forward. Now, let's look at the NASDAQ. I think the NASDAQ had the perfect picture for us as far as what to expect this week when we started the week. For those of you that remember that were here last week, once we pulled back, I said there's a possibility that we rally sharply in the next couple of days. And if we come right back up to 189, this now becomes a pretty important resistance area. And for the moment, that's what we've seen so far this week. We've been knocked down pretty quickly off of this 189.50. You can see we start on Monday trying to break through it, and then yesterday we had a pretty big sell-off. And today, like I said, it's nice to see that we didn't continue falling apart off of yesterday's sell-off. We found buyers, and for the moment, we have a pretty constructive candle. Now, again, we've got a few more hours into the close, and I think the key here is that we try to maintain this. And if we do, there's a good chance that we come right back up and try to test 189 again. Now, are we ready to break it? Maybe, maybe not. We'll see. We've got another sort of pennant developing at the moment, but I'm not even going to keep that trend line for now. I just wanted to point out that the trajectory is up again. So we're still finding buyers. This was a nice little reversal pattern, these two long wicks and these two candles with the bullish engulfing, and we're trying to make our way back up. But when you see a breakdown from a triangle like this and you lose that level, this becomes a really critical area of resistance, because you have a lot of different areas of potential supply and a potential distribution, right? You've got this, what was a bullish sentiment that has now been broken, right? So you got a lot of traders that are on the wrong side of this if they're still trying to maintain that sentiment. You've got this important value line which has been broken, and then you've got this bearish sentiment where you've got traders that think the market is going down, right? So you've got three different points of view, and none of them are bullish. So in order for us to flip back to bullish, we have to break through all of this. Now, for those of you that maybe don't understand what I mean by this, these trend lines, you know, a lot of people that aren't comfortable with technical analysis, to look at it and they'll say, well, you're just drawing lines and connecting dots on a chart. Well, the truth is that these lines represent trader sentiment, right? A horizontal line tells you what traders value or find overvalued in the price of an equity, and any sort of angled one is just bullish or bearish sentiment. And so we had bullish sentiment in the short term that was broken. We had this potential area of what was considered too high of a price for the NASDAQ, and then eventually turned into a potential area of support or value, which ended up being negated pretty quickly. And then now we have this newly developing bearish sentiment as we topped out at 195. So you've got these three trend lines that are telling us that the bulls are losing control of the NASDAQ at the moment. Now, in order for this to change, we need to be able to have the price action push back through all of these different indications of sentiment and start to push back through. So until that point, we have to assume that 189.30 is a pretty important level of resistance, and one that is likely to be met with a lot of selling and a lot of supply. So that's the key area for us to break. Now, if we do find more sellers, which is the likely scenario, then what we want to see is we want to continue to see buyers step up and support price before it comes all the way back down to 178 to 180. So far, the 200-period moving average hasn't really been touched since May, and the buyers are still stepping up in front of it, and you can see it's still kind of curling upwards. So the overall trend is still up, despite the fact that in the recent term it's been basically sideways. And a lot like the S&P 500, I think the key here is as long as we don't lose 178, I think that we're still fine. If we lose 178, I think that's the important line in the sand, and I think that means that we're going to see more selling pressure, and it should be a quick move back down to test our June lows at that point. And at that point, then we have to start to reassess and figure out whether the lows from the last couple of years are in the cards or not. And we'll see when we get to that point. But for now, we want to see what happens in this area. And I have a feeling the NASDAQ is going to be impacted strongly in the next couple of weeks once we start to get the FANG stocks reporting their earnings. Until then, we're probably going to just continue to chop back and forth and try to figure out what side we want to break of this range, whether it's the 178 side or the 189 side. If we look at the Dow Jones, we're going to see a similar picture. As we can see, and I'll extend this a bit just so we get all the candles. We have the same sort of scenario, right? We've got newly formed bearish sentiment. We've got this horizontal level of what was resistance turned into support and is turned back into resistance. Now, we don't have that ascending trend line quite as clean. I don't think that this is quite as significant as the NASDAQ trend line, but there is something there. But I'm not going to keep that. I don't think that's really that relevant at the moment. What's really critical here is these horizontal levels, particularly 265. So it's the same basic scenario as what we saw in the NASDAQ and the S&P 500. If we want to flip around to turn bullish and look at a possibility of moving back to all-time highs, we need to get above 266. That's going to be a very important technical level to break through, and that's really the key. If you want to turn bullish in this market, you want to see this 265 level breached. Now, if you're scared of this market, then we have another potential double top forming here, and the key is that price action has to stay above 254 or so. As long as we stay above that, then I think we're fine. You'll notice a little bit of relative weakness on the Dow Jones. We actually did breach momentarily the 200-period moving average. We did touch it. We had this nice wick across it, but price action is slowing down on the Dow Jones as it starts to struggle a bit. You got the 50-period moving average kind of curling down, and overall, again, I think it's more indicative, more than anything, again, of a neutral market environment. But we do have to watch to see what happens as we kind of pull back. Again, the price action from last Thursday and Friday was pretty bullish. I mean, not very bullish, but it showed that we weren't going to pull all the way back to the what would be the neckline of this double top. So it showed that buyers are still stepping in, and they're not really willing to give up some of this hard-fought ground that they've made up throughout the 2019. So the question now is, do we have to retest it again? And if we do, as long as we stay above that and we don't come all the way down to 254, I think it's still bullish in the long term. In the short to intermediate term, of course, it's still kind of neutral. In the very short term, it's still a little bit bearish. But I think the key, again, it's the analysis is the same as the S&P 500 and the NASDAQ, so I don't want to kind of continue saying the same things. But we need to just either break 266 to get bullish or stay above 254 to avoid becoming bearish. And if not, then we continue to assume that we're neutral. And as long as we're neutral, really, we're just consolidating, trying to build up pressure to try to break out to the upside as we close out the year. Now, the one divergent index is, of course, the small caps and IWM. And as you can see here, it's a completely different picture. And basically, until we can get above 158, I have a hard time believing that the market's going to be ready to rally to new highs. And as you can see, we were rejected pretty soundly again and we came all the way back down to the bottom of our range. And I think this is the one area that's kind of putting more fear into the market in general, is that there's no more levels of support after this, right? So if we lose this 144 to 145, there's a lot of room to the downside. So unlike the S&P 500, the Nasdaq, and the Dow Jones, where there's room to pull back to a line in the sand, with IWM, with the small caps, we're kind of at that line in the sand already, and it's kind of important. Now, the small caps have been weaker for the last couple of years. Actually, really in the last decade, they've spent the majority of the time being the weakest of the four. And so it's not the end of the world if the Russell 2000 falls below this range. And again, I'll go to the weekly chart and show you what it looks like on the longer term chart. You can see where we stand now. Of course, there's a lot of room to the downside before we lose last year's lows, but I consider this to be more of a big break through that range rather than a definition of the range. I think for the most part, you could consider the range we spent the last couple of years in as being something along the lines of 170 and about 144, 145. And we're right back to that level. And if we lose that, I think it's going to be a pretty quick move down to about 142, 140. And at that point, that would be a pretty bearish development in the small caps. Does that mean that the S&P 500, the Nasdaq, and the Dow Jones are going to follow suit and go down and break through their yearly lows? Probably not, but it would certainly signify that they're going to have to come down and start exploiting the bottom edges of their range from the last couple of years as well. So what we need to see now is hopefully a change in character where IWM picks up some relative strength and finds a bounce quicker and starts to try to make up this ground. Now, unfortunately, we've been hoping for that for the majority of the year, and it really hasn't happened other than maybe sometimes 2 or 3 days at a time, and then it eventually loses track and just comes back to its normal pattern of behavior. And so we're right back where we are. If you notice, the bounce the last couple of days is weaker than what we're seeing in the other three indices. So overall, it's showing that traders are still sort of distrustful of this market. For those of you that maybe don't listen to me all the time, IWM is a good representation of risk appetite in the market. If you look at the four major ETFs, right, you have the S&P 500 and the Dow Jones are kind of the middle of the middle road. And then you have the Nasdaq, which has a lot of tech names, and you have IWM, which has a lot of small caps. They tend to represent more risk because they tend to have more volatile assets, particularly IWM more than the Nasdaq. Because the Nasdaq now, with the FANG stocks, they have some of the big tech names are basically representative of the market in general. But with the small caps of the Russell 2000, you tend to have more volatile assets that move stronger in a market that's trending upwards and move more strongly to the downside when the market is trending in the opposite direction. And so when things are going well, traders are going to sort of gravitate towards the riskier assets, right? Because they're going to get more volatility, which is going to be a more positive return. However, when a trader is fearful or distrustful of the market, the first place they're going to abandon is going to be the small caps, because these are the names that have more volatility and more potential downside risk. And that's kind of been the case for a while now, is that traders have had one foot in the market and one foot out, and the foot that's out is always going to be the one that it's in the small caps. And so we've had the small caps underperforming for a while, which has been a warning that we really, even though we continue to probe highs on the other indices, right? So if you look at, say, the S&P 500, and if you're just looking at the S&P 500, you're like, well, the market continues to push upwards. It keeps pushing to new highs. And while we keep making incremental highs, we're not really rallying as strongly as we did before because traders still have a certain amount of fear of the market in general. And that's why they're not willing to absorb the risks that entail holding the small caps. When we're really rallying strongly, the small caps were performing with us. And so until we see a change in this, it's hard for me to get behind a new rally to new highs, and I mean a strong rally to new highs. So what I want to see here is a push through back above 150s and getting us back above 160. And I think that's the key. If we can get above 158 to 160, I think at that point we can be pretty aggressively bullish in the markets. Until we get above that, then we really should be trading in a more neutral stance and assuming that the market is range bound. Even if we do make incremental highs on some of the other indices, we're likely not going to build upon those highs very strongly. And so this has been kind of my tell this year, and why I've remained neutral, and why I've done a lot of a lot of volatility sells with options is because IWM has kind of shown me that the market isn't really ready to assume a more bullish stance and aggressively rally. Now that being said, I still think the lines in the sand that I have on the S&P 500 and the Nasdaq are more important as far as downside warnings compared to what we see in IWM. But if IWM loses 144 to 143, we're going to see those levels that I mentioned earlier on the S&P 500 and the Nasdaq and the Dow Jones breached as well. So we have to keep an eye on that if we want to have a kind of an early warning signal as to what the market wants to do. So overall, when you look at all four of these, what you end up getting is a picture of a mixed market. And I think that's why we've remained neutral, and that's why we continue to chop around and try to figure out where we want to go, is because the market right now has some cross currents. And it shows that while there is a lot of bullishness underneath the surface, there's also a lot of fear, and that's keeping traders from really getting full on behind the idea of an aggressive rally in the markets. And we'll see whether this next earnings season can do something to change that attitude, or maybe it's going to have to be a final resolution with China as far as trade agreements, or maybe it's going to have to be a more definitive answer from the Fed on what they want to do next. But we're going to have to get some kind of conclusion that's going to let traders become a little bit more confident in this market, or if they lose even more confidence, then we're going to turn around and trade to the other side. But if you're a swing trader, ultimately the direction, even though most of us prefer bullish, if you know how to trade technicals, then a bearish market is fine as long as you're not too aggressively involved in the market with your holdings. All right, so let's take a quick look at the US dollar. We have a few new viewers that jumped in midstream. If any of you guys have a chart request, feel free to type it into the chat. If those of you that don't know how to access the chat, there's a little tab on the top right that you can use to expand, and it has a chat menu on there. And you can let me know what stocks you're looking at, and I'll give you my thoughts on it, and I'll basically give you my analysis on that equity and what I think about it. If you're in a trade, let me know, and I'll try to give you the information that is more relevant or valid for what you're looking for, rather than just me spewing on about a stock. So here's a look at the US dollar as an aggregate. And overall, the US dollar continues to climb higher, continues to bode pretty well. Now, the one thing about this is that a lot of this is due to euro weakness. If we look at individual currency crosses, you'll see, wow, there we go. You'll see that the euro has really struggled versus the US dollar. Now this chart is based off of euros, so that's why it's going down, is the euro is struggling. In this particular case, down is good for the US dollar. And as you can see, the US dollar, for the most part, this chart mimics, or is sort of a mirror of what we're seeing on the UUP index. Now, the euro did find a last gasp support level here at 109 to just to the upper 108s. And it's trying to break this downtrend, but it's kind of struggling. This is a very critical area. And for those of you that are gold or silver bulls, this is a very critical spot for you to watch. I know I've had, last week we had a request on silver. I've had some people behind the scenes ask me about silver and gold as well. And if you are looking for gold or silver to continue to bounce, this is a critical level for you. You want to see the euro break above here. And thanks, Joe's Cleaning Lady. We'll take a look at that chart in a minute. Wow, hold on a second here. This is all right. So right around 109.5 or so, 109.95, or basically we'll call it 110. If the euro could break through 110, then I think we're going to see a big move on silver and gold. If the euro struggles here and rolls right back over, then I think that's going to mean that silver and gold are going to have some trouble, because that's going to mean the US dollar is going to pick up more strength. Now, interestingly enough, if we look at the US, we're going to look at the US yen first. If you look at the US versus the yen, it's not the same picture. Now, again, this is based off of US dollars, so up would be good for the US. And you'll notice that this chart doesn't reflect at all what we're seeing in the UUP index. So as far as the US as an aggregate is concerned, it's really going up because the euro is going down. Because if you look at it versus the yen, it's actually struggling versus the yen. And while it recently has found a potential bottom, you can see this was a nice double bottom. We were able to break through, and now we're using this 106.7 as a nice launching pad to continue upwards. really all we've done is kind of turned into a more neutral environment rather than a bullish one. We found a little bottom, and we're attempting to maybe establish an even bigger inverse head and shoulders bottom if we can make our way back to 1086. But for the most part, it's just trading sideways, and it's trying to establish and break a previous downtrend and try to establish a new base of operations to try to break higher. But overall, it's very, very different from what we're seeing in again, if we look at the UUP index, where the US dollar has just been climbing steadily. Now, finally, we have the US Canadian, which we like to look at. And as you can see on this case, the US versus the Canadian, again, is mostly neutral. Now, it is attempting to have a nice bullish breakout here. Now, this chart is inversely correlated to oil, which we'll get to in a minute. So what we're seeing here is a potential breakout, which would, again, mean that oil is probably attempting to fall back a bit. And again, we'll look at oil in a minute once we look at gold and silver. But overall, if we look at the US dollar, it's kind of stuck in neutral, except for the fact that the euro is stuck in reverse. And that's what's making the UUP index and the US dollar in general go higher, is because of how poor the euro is acting. Now, this of course is going to impact gold and silver because they're priced in US dollars, right? And as you can see, with the euro starting to break down, gold and silver broke down as well. And they've had a nice little bounce to make their way back up, but what was previously a support area should now turn into resistance area until we see that break in the euro or the US dollar. So what we're seeing right now is a downturn in silver and gold. You can see it very clearly on the silver chart, where this little gap area was a nice support area, and it eventually led to a nice move higher, but that failed very quickly, and now we're on the wrong side of that, right? And so as long as we're on the wrong side of this, we have to assume that there's going to be more downside action. So if the euro turns down again, we're going to see silver break this trend line, and it's going to likely head all the way back to 1580 and possibly all the way down to 1550 to 1540. So keep an eye on that. If we look at GLD, it's not quite as pronounced, but we're starting to see price action tighten up pretty strongly. And again, a lot depends on what happens with the euro US dollar. I think if the euro can break out, we're going to see GLD break through this 142 area and make its way back up to 145, 146. If it fails, then we're likely going to head right back down and test 139, 138, and probably head all the way down to 135. So again, if you're looking at gold or silver, keep an eye on the euro, because I think that's going to be a pretty important tell for you as far as figuring out whether these guys are ready to break through or not. And then finally, we have oil. And oil did not bounce like we were hoping. It ended up breaking down, which we discussed last week in detail. And it's finding some support, but at this point, this could just be a bear flag. And if that's the case, it may break down and lose the $50 price point. I suspect it probably tries to break out and make its way back up to 54, 55. But at this point, once again, it's basically still just really struggling. It can't get an uptrend going, but at the very least, it keeps finding support around the $50 range. And we'll see what happens next. And depending on what this does, that's probably going to have an impact on the U.S. Canadian. Now, I know a lot of you guys don't trade Forex charts or trade currencies, but it's important to watch them regardless of whether you trade them or not. I actually do trade them. Sometimes they give me good trades when the market is not cooperating properly. So sometimes it's easy for me to find that trade in the euro or in the US Canadian if the market is misbehaving and is not giving us trades, which lately the market has been it's been pretty tight as far as trying to give us trading opportunities, because we've been chopping back and forth. It's been difficult to find trades that are setting up properly because we often fluctuate back and forth and aren't really getting good risk reward based off of that price action. So sometimes it pays to be able to use your technical analysis to venture on and trade different types of equities. So now that we have a better idea of what the market's doing and what's happening with commodities, let's take a look at some chart requests. So Joe's Cleaning Lady. We're going to look at Ultra Petroleum Core. Nice segue now that we just looked at oil. All right, so oil, gas, and exploration. Now, let me know, are you actively trading this, or are you looking for a possible entry? Let's take a look at the weekly chart. I've never actually looked at this chart, or never actually did analysis on it. All right, so this thing has been struggling pretty bad, right? So um, at this point, I would assume, and you can see on the news, this stock has some kind of technical or some kind of fundamental issues. It's been having some trouble with cash flow, I guess. Okay, you're short. All right, well, looking at the weekly chart, that's the right idea. Or you're looking to short. Okay. All right, so now that we have an idea, so this chart is, this stock has obviously been struggling. Now, I will say this, it is trying to bottom out, and it is trying to find itself, it's trying to break that downtrend. Let's see if on the weekly again, if we get a better, no, I mean, this is just too steep of a price pattern to really get a good gauge. All right, so it's just been struggling for the most part. All right, so the key here is, I'm going to do a couple of things here. All right, so as we can see, the last time I had a downtrend, or the last time it broke a downtrend when it was trying to find a bottom, it eventually broke it here, and so that level should act as a potential target, or somewhere where you'd worry about traders trying to find more value, right? So when you have a breakdown like this, and you eventually have this rounded bottom or this bottom, and then a breakout, this was the breakout level from this recent downtrend, right? So that would be ultimately what you're probably looking for as far as where it's going to move. Now, it might not actually get there because we do have a little bit of an uptrend developing, but just to keep an eye on what's going on. Now, as far as where you want to short this, there are two levels. And I think ultimately you want to move back to 33 to 35 cents. Because this is kind of an intermediate level, and there's a good chance that price struggles at 28, but more likely than not, if you're really looking for the safest level to go ahead and get involved, it would be if it tops out around 32. However, this thing has been pretty weak. And so despite the fact that we've got 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, basically 12 green days in a row, it's only moved up from 19 to about 25. So it's only moved up 6 cents in that time span. So it's having a lot of trouble climbing through all this area. But you can see the real resistance areas are 28, basically 28 cents and 33 cents. So what you could do here is, I'm not sure if you're going to short this. Well, I'm assuming you're shorting it with shares, because I'm sure the options on this are pretty poor as far as liquidity is concerned. You could start a position around 28, and then you can add if it continues climbing to 33, and then you would stop out if it gets above that. Now, the one thing I would say is, don't, just because it reaches these levels, don't short it just as soon as it reaches. You want to see a reversal pattern. I think that's the key, is you want to see an attempt upwards, something like what we saw. Oops. Something like what we saw here, right, where you have a move up to the level, and a lot of people will get aggressive and short that level immediately, and then they'll get stuck waiting for it to actually work in it, because it's not really ready to be shorted. Then once you have this move here, you had the move, and then you had the spinning top, then you had the negative next 2 days. That's when it's really good to go ahead and short. So what you want to do is look for a reversal pattern somewhere in this area, somewhere between 28 and 32. And if you can get it from there, then you'd be looking at a move down here to about 19 or 20, and then hopefully all the way down to 17. I think it would probably not get all the way down to this lower level, around lower than 10 cents, because I think that this was a pretty big break trying to define and establish a bottom. But until it's able to break through 33, we can assume that at the very best it's only in a neutral stance now, as opposed to, I don't think it's flipped to bullish yet. I think all it's done is try to establish a bottom. And until it can break through 33, we have to assume that it's going to be range bound between about 16 and 33. So I would play that range. Now, unfortunately, right now, it's almost right smack in the middle of the range. So for now, I wouldn't be too aggressive, long or short this, depending on what the person is thinking. I would try to play the edges of what's starting to be established here. And again, you can see the range, you can see that price level something like this, right? So that would be the range that I try to play, is these two horizontal lines. Okay? Wes, you're looking at iRobot. So I just had an analyst downgrade. I found a lot of times the analyst downgrades tend to be the kind of the end of the move. Let's see when they have earnings. That's one other thing, by the way. Keep an eye on the earnings date. Any of you guys that are looking to trade a stock right now, make sure you pay attention to what the earnings date is. So let's look at UPLC again. Oh, it's not even on. Okay. So iRobot is going to report October 22nd. Okay, so keep that in mind. Any trade you would try to take on this, you probably want to be out before October 22nd, particularly on iRobot that's had some pretty drastic gaps up and down. So there's been some volatility on it, and I'm sure a lot of these are earnings events. So your thoughts on this, or my thoughts on this, Wes, is typically I don't trade news. I try to just trade technical analysis. I try to use trend lines. So when I have a stock that has bad news like this, I usually don't get too excited about trying to trade it. But I have noticed a lot of times with analyst downgrades, usually that's kind of like sort of like a sell the news thing. Once it gets these downgrades, it seems like the news was already sort of priced in. Like most people knew it was. That's why it kept breaking down. And so that would hopefully be the bottom of this trend, right? You can see it found some buyers today. The candle's so bad it's hidden in the volume, but there's a nice little doji here, and if you want, I really wouldn't want to buy this right now. I think that there's all right, so that becomes a level of a resistance, right? So what do we have from here? We've got from 54 to 57. We got 3 points of upside, right? Today, the bottom of today's candle, I think, is around 51, right? 51.11. So if over the next couple of days this thing struggles and comes right back down and finds some support at 51, then maybe we get good risk reward to trade from 51 up to 57. But if this thing just tries to move forward tomorrow, well, then what do we got? We've got 3 points of upside and we've got 3 points of downside. So at the moment, I'm not really too excited about this as a trade because clearly it's not doing well, right? I don't think I want to short it because it's already been going down so drastically and it had the big gap down today and it's finding some support on volume, right? But I don't want to go long because, as you can see, there's a lot of overhead resistance and it's only 3 points away. And really, today's lows are 3 points away, which means there's a good chance that this thing drifts all the way back down to 51 just to establish that bottom or just to retest that bottom. So if someone wanted to go ahead and try to catch a knife and wanted to play this to the long side, at the very least, you want to get the best risk reward possible, which means waiting all the way down to about 51. And frankly, I think that there are probably safer names or healthier names that are going to give me that risk reward rather than trying to catch a knife on something that just had analysts kind of badmouth it, and then we've got earnings coming up in a couple of weeks. So more likely than not, it's going to be kind of flying a holding pattern until earnings anyway. So I'd probably stay away from this. However, if you really were excited about it, or you really thought that you like the company and you feel like that this, that it was an unwarranted downgrade and you think it's going to bounce, then you want to wait. At the very least, you want to wait for better risk reward. So you want to wait for the mid 51s and see some kind of support off of a drift upwards. If it opens up tomorrow and keeps climbing, well, it's going to have to clear a lot of stuff before it flips to bullish. So I really wouldn't be too worried about missing a move if it moves back up to 57 tomorrow. It's still going to have to chop through all of this and eventually break this downtrend. So it's got a long way to go before it's over here, which is where it would be more bullish and more indicative of attempting to bottom and make its way back up into the 60s and 70s. So a lot of work to go on this. And at the very moment, if you were really trying to catch any kind of reaction to this, you need better risk reward, which means you need to see it come right back down. And of course, if it comes right back down, that means maybe it's not ready to bounce anyway, right? So kind of a catch-22 on this. And I think I'd probably stay away. Because, I mean, even if you look at it, that trend line I was drawing, you can even say it's underneath this channel here, right? And if that's the case, there's a chance that it really struggles. So I would do this. I'd watch this. And again, if it could get back on the other side of this channel, then maybe it wants to make its way back up to 57, and maybe you have a good risk-reward trade there. But if not, just pretty much stay away from it. I don't think it really presents a good opportunity. All right, does anyone else have something they want to look at? Feel free to type it in there. Don't be shy. We've got a few more minutes. Duncan? All right, so Dunkin' Donuts also struggling recently. A little bit better because it's on the 200-day moving average, and we did find some nice buying today. So again, a nice routine to get into for the next month. And if you guys always check the earnings date, you do not want to take a trade on a name and then it has earnings the next day and it gaps on you 20% and you weren't ready for it. Okay. So Dunkin' reports on Halloween, so we've got some time on this. So if you look at what Dunkin' Donuts has done, right? 79 was basically a floor for it. It was trying to make its way upwards, trying to make its way to new highs, and ultimately it failed at that level, and it kind of came down. And it found some support down here around 75, 74. Now again, if you pay attention to what's been going on, and well, this is a tough one, but basically that became a level of potential support right around 75 to 74. However, if we look at this level of resistance, we have a sort of this gap between 79 and 77, which is going to be pretty important resistance as it tries to make its way upwards. It's kind of already there. It's a 76. This had a very strong bounce today, and unfortunately, the risk reward's not there right now for a trade on this as well. Now, I think 77 is not as critical as 79. I think 79 is ultimately the ceiling for it in the short term. We'll see whether it can continue climbing or whether it continues this sort of downward trajectory. If it comes back down to 74, then you can go ahead and try to trade it from 74 to 77 and then 79. Again, that's only 2 or 3 points of upside, but the downside would be pretty low here, depending on where you wanted to put your stop. And this is another indication of what is making finding stocks in this market a little bit more difficult, is that at the moment the risk reward in a lot of these names is not great, because we've had a lot of violations back and forth at different price points, and so what happens is you get these moves like the move we had today. If someone didn't buy right at the open when they shouldn't have, because there was no clear indication of a pattern, if you bought this at anywhere below 75, you were basically just guessing, right? And now at this point, when we have a candle kind of telling us that we bottomed out, it's already way too far for us to really go ahead and go long. Because again, we're trading at 76 right now. You can't really put a stop anywhere lower than maybe 74, or anywhere higher than 74. So that's about 2 points away. And yet you've got overhead resistance basically 1 to 3 points away. And so you might be right in that this bounces, but it might not make it a good trade, because you can't really control whether stock goes up and down. All you can control is what your risk and your reward is. And at the moment, the risk and reward in this trade is again, not great if you were trying to look for a bottom. Now, personally, this is the kind of stock, if the market were continue to struggle, I might look at this as a short if it starts to climb up and get stuck in this 78 area, where at that point I could look at a trade from 78 to 79 with downside all the way to 74. Now, that's not something I'm looking for right now. A lot would have to go into it before that would make sense to me. And ultimately, it would have to be a market that continues to turn around and trade down. So if this thing were to bounce for the next 3 days and come up to 79, but then when I look at the NASDAQ, and I see the NASDAQ struggling and then it rolls right back over, well then something like Duncan could... I'm fat fingering like crazy today. Something like Duncan could offer us with a similar pattern where it comes up and bumps up into serious overhead resistance, and then if it fails, now that's a lot of what ifs. So I'm not recommending to wait and put this on your short list. I'm just saying that if things were to play out correctly, this would maybe provide me with better risk reward in that direction. You're saying it has been really hard to find clear buy signals lately. You've cashed out several positions over the past couple months, and just wait. And you know what? I'm in the same boat. Because I agree, and that's what these kind of markets do, is they force traders to lose their discipline. It's not the same, So to go back to a chart of the S&P 500, right? When you're trading in a market like this is a tough market to trade. It's when you look at what, say, the beginning of the year, right? These markets are awesome to trade because the stock market just goes up, and there's a lot of... The hardest part about trading a market like this is waiting for consolidation, right? Same thing back at this point in the middle or beginning of the year, when the market has a nice clean move, or last year, in the middle of last year, when the market is trending like this, it makes a much easier environment because the stock market is giving you nice, easy signals, and most of the stocks are moving similarly. Even at the end of last year, when you had all this volatility, it still wasn't that hard to find trades because there were defined levels and the market was doing something very similar, even if it was eventually tanking. Now, when you have a market like what we're seeing right now, it's harder because the market is constantly fluctuating back and forth on the whims of whatever news is on TV. And it's really a market that is trying to struggle. And so what ends up happening is, again, it tries to entice you to chase these plays when they're not ready to be chased, right? So it tries to get you to chase this higher after you've lost a good risk reward. And so what you have to do is be patient. You have to wait for the right opportunities, or you have to do stuff like what I did. So like, let's say Winnebago. Winnebago was one of my Patreon trades from a couple of weeks ago, which I'm planning on doing a post updating it and showing exactly what's happening with this. So this was a stock that we looked at as a short trade as it approached resistance up here at 40 to 40, 39 to 40. Now, I didn't short it outright with shares. What I did was I sold volatility on it. I ended up playing a calendar spread where I sold this month's calls and I bought next month's calls because in my mind, this was not a stock that I thought was going to head back down to 30. I thought it was just a stock that needed some trouble or some time to really work its way through this level. And so it made sense to sell volatility because the stock was more likely than not going to stay range bound. And so I found that in my style, the trades that have been working are the ones like this where I take advantage of the fact that the market's going to chop by selling volatility. Now, I understand not everybody's comfortable with options. Not everybody can trade in that manner. But if you have the ability to trade options, if you know how, then during this kind of market, it makes more sense to just go ahead and sell volatility because it's basically just chopping back and forth. And if you can work it out that way, then you end up getting trades that work much better. And this trade's cleared 100% for us. It's doing very well, and there's a chance for us to turn it into a trade that can make another 100 and turn it up to 200% depending on how we flip it into next month. And like I said, I'll probably do a blog post in the next day or two and kind of update what we've done with it. But the idea here is not necessarily to look to short, but you play the edges of a range, and if you can, you take advantage of the options to go ahead and sell premium and take advantage of the fact that it's going to trade sideways. Now, if you don't use options or you're not comfortable selling for premium, you could just play the edges of the range, whether it's through covered calls or whether it's you just short at the top or you buy at the bottom. But it makes more sense right now to find a stock that you think is trading in a very defined range and then trade that range. And I think that makes more sense. Now, that being said, it's been it's been a pretty slow last couple of months. For those of you that follow me on Patreon, you'll know that I've been basically just recommending maybe one or two trades on Mondays, and I'm not really finding a lot of other trades throughout the week because it's been kind of slim pickings in the market so far. And I don't want to just put out ideas that just because I want to put out an idea every day. If I don't think if it's a substandard idea, I think that only hurts traders. And I think it's more important to understand when to scale back and when to avoid trading rather than just constantly throw out ideas just because I feel like people want them. I'm still only going to offer trades that I'm looking at actively myself, and I'm not going to put something on there if I'm not interested in taking it myself. Like you, I've been looking for, and it's been tougher to find trades because the risk reward has not been there on a lot of these stocks. But these are the kind of markets where they test your patience and they test your discipline. And if you're going to be a successful trader, then you have to understand when you're supposed to sit on your hands and when you're supposed to be aggressive. And I think right now we're just supposed to kind of not necessarily sit on our hands, but be a little bit more careful and a little bit more disciplined on what we want to look for and how we want to trade. Now with earnings season coming up, usually that works out great for me because I have a style of trades that I do during earnings that have nothing to do with the market, and usually I could find 2 or 3 trades a week like that. And so hopefully I could share a few of those with my Patreon members as well, and maybe we find some trades that are not correlated to the market at all and tend to just be 1 or 2 day plays based on how markets or how stocks behave during their earnings reports. But we'll get to that as we move forward into the earnings season, and hopefully they present us with some good opportunities. We tend to need more volatility in the market for those trades to really work out, but we'll see how that happens. So that's a good comment, by the way, Wes. I appreciate that. I appreciate you being honest and pointing that out. You're not alone. I think a lot of traders are finding it hard to trade right now, but we should get more clarity soon. I think as we get into earnings and as we start to get into the holiday months, we should get a little bit of hopefully a better market, but at the very least an easier to read market and one that's trending in one direction. So we'll see what happens there. I want to thank you guys for participating, those of you that did, and everyone that attended, thanks. If you have a question that you didn't want to ask or you kind of missed out or you're too shy to ask, you can always ask me on Twitter. You can find me on Discord, and I'm more willing to answer on there, or you could even email me, stockdarts@gmail.com, and I'd be happy to answer your questions there as well. Hope you guys have a good rest of this week, and we will meet again next Wednesday.